Welcome to our comprehensive guide on interest rates. Today, we will break down everything you need to know about interest rates, how they work, and why they're critical in the finance world. To start, let's define what interest rates are. An interest rate is the cost of borrowing money, expressed as a percentage of the amount borrowed. It can also be viewed as the return on investment for savings. There are two main types of interest rates: nominal and real. Nominal interest rates are the stated interest rates on a loan or investment. Real interest rates are adjusted for inflation. For example, if you have a savings account with a 5% nominal interest rate and the inflation rate is 2%, the real interest rate is approximately 3%. Now, let's dive into how interest rates are determined. Central banks, like the Federal Reserve in the US, play a significant role in setting base interest rates. They adjust these rates based on economic conditions. For example, if the economy is growing too fast and inflation is rising, the central bank may increase interest rates to cool down the economy. Let's visualize how interest rates have changed over the past 2 decades. But how do interest rates affect everyday activities like saving, borrowing, and investing? Higher interest rates can make borrowing more expensive, but can also provide higher returns on savings. For instance, if car loans rates increase from 3% to 5%, the monthly payment on a $20,000 car loan would rise from $359 to $377. On the flip side, a higher interest rate on a savings account can increase your returns. Let's check if you remember some key points. What is the difference between nominal and real interest rates? Nominal interest rates are the stated rates on a loan or investment, while real interest rates are adjusted for inflation. Great job if you got that right. Now, let's discuss how interest rates influence the stock market. Generally, higher interest rates can lead to lower stock prices as borrowing costs increase and corporate profits may decrease. Here's a simplified example. If Company A has to pay higher interest on their loans, their net income might decrease, which could lead to a drop in their stock price. Let's look at some data on how the S&P 500 index has historically responded to changes in interest rates. It's important to understand that interest rates are just one factor among many that can influence the stock market. Other factors include corporate earnings, geopolitical events, and overall economic conditions. Another area where interest rates play a crucial role is in real estate. Lower interest rates can make mortgages more affordable, boosting the housing market. For example, if mortgage rates drop from 4% to 3%, a borrower could save approximately $167 per month on a $300,000 30-year mortgage. Let's visualize this saving with a bar graph showing monthly payments at different interest rates. Ultimately, understanding interest rates is critical for making informed financial decisions. Whether you're saving, investing, or borrowing, being aware of how interest rates impact your finances can help you plan more effectively. Thanks for watching. Make sure to subscribe for more finance tutorials and leave your questions in the comments below.